Okay, my name is Ralph Simon, and I'm with the Lcms Foundation for almost 8 years. And the title of my talk is Investing for the Long Term. So my background is financial services. I was with the late great AAL for 12 years, and then continued on in financial services after it merged and became Thrivent. And so I've been with Synod a total of 15 years. 7 was with Concordia Plans, so I can answer some of those questions too. So my title is Vice President of Investment Services. Our goal is to talk to congregations, sometimes endowment funds, sometimes church councils, sometimes a scholarship committee, for different things like that. So feel free to ask any questions as we go along. So the goal is that we can help with planning your ministry's future. I'm a member of a...
Is it okay if I snag a chair?
Sure. I'm a member at the Historic Trinity in downtown St. Louis, which is Walther's church. So we're 184 years old. And in 1900, Trinity had 4 elementary school buildings with 500 kids in them. Fast forward 100 years to 2000, we have 57 kids, all free tuition. 2/3 are not members of the congregation, and we're out of money. So we had to close the school. We ran about 10 years of grants from different organizations before we had to close the school. But if you think of 500 kids in 1900 in schools, probably had 2,000, 3,000 people in worship on a weekend. If they had started an endowment like our seminaries did, we'd still have a school in downtown St. Louis. So our seminaries have over $100 million in their endowment because not only have they had time to solicit contributions, they've had time for the market to grow. So Synod's dealing with the issue, as many congregations, is that giving is down with the pandemic. And the other problem is the inflation rate is 7%. So when you put the two issues together, you're having shrinking purchasing power, especially if you've got money sitting idle in the bank. From doing this job for over 8 years, I am pretty convinced that there is literally hundreds of millions of dollars sitting in corner banks owned by a Lutheran organization. And it's a good thing we're saved by grace, because if it was stewardship, we got a real problem going on. So what we want to do is help you plan for tomorrow. Look at some of the resources and talk about how to call them for the long term. Ministries should think of investing over decades. When I talk about Historic Trinity in St. Louis, you could easily say there's been 9 generations go through that congregation. And so what's neat about this topic is that as humans, we're used to thinking about our life expectancy and saving for retirement, or maybe saving for children's educations, maybe 18 years or so. But in reality, churches are going to live much longer than individuals. So in talking to these decision makers, it's important to take the Etch-a-Sketch and shake it and get out of the normal thinking, because this church is not going to be passing away in 75 or 85 years like a human will be. As witnessed in Synod, there's probably 3,000 congregations that are more than 100 years old. So we want to talk about how to beat inflation. Right now the headlines are it's close to 7%. And of course that's diminishing the shrinking power, especially when you got assets sitting at the bank earning probably 0.25%. And so we'll talk about how to invest. So the big picture is, in general, let's talk about asset classes. This slide is put together by J.P. Morgan, and it's a lot easier to look at it this way. It's put together by J.P. Morgan, who is... Sweet. Glad to hear they're getting something out of it. So this is a pretty busy chart. This kind of reminds me when I'd go to Grandma's house in the 70s. It'd be laminated and be the placemat at Thanksgiving with all these different colors on it. But you can see these are years at the top, 2007 all the way over to 21. And then if you go down the 2007, and you might want to write, if you find this interesting, what those initials mean. So the purple one in the top of 2007, that means emerging markets. Examples of that would be small companies in Brazil or China. The second space in green is commodities, your oil, gold, silver, palladium that they're talking about, the chip shortages. DM is developed markets. Developed markets would be like Germany and Japan. Asset allocation is a blend of all these things, so we'll talk about that. Fixed income, that would be bonds in the United States. Large caps would be large companies in the United States. Cash is money at the bank or CDs, savings accounts. High yield, that would be bonds in the United States that don't have a great credit rating. Example would be Ford Motor Company, General Motors, Sprint, Bed Bath & Beyond. They don't have great credit ratings, so they borrow at a higher rate of interest. Small caps would be small companies in the United States. And then the last one, REITs, REITs, is Real Estate Investment Trusts. So when you look over a period of a couple decades, all of these asset classes will take their time in being a top performer over the years, is what this is showing, is that there's, whenever, us guys tend to talk at the lunch table or in the locker room about what's hot, where are you going to make your money this year? Well, this is a good demonstration of it, is you never know where to be. And the importance is to have a blend of assets. The assets that we offer for congregations to invest in, that we'll talk about in more detail in a few minutes, are pretty vanilla. We don't invest in hedge funds. We don't invest in commodities. So that's one of the items on here that is on this JP Morgan sheet. We don't invest in Bitcoin, those kind of things. We're pretty vanilla flavored investment services. One of the takeaways that you want to see on this fund is that you can't really be in the right place every time. And so being in a blend of these things is how you can achieve some financial success over time. The next slide is, again, these are not specific of our funds. These are done by one of our money managers, JP Morgan. And it's talking about of all these different asset classes that we just talked about a second ago. This is talking about the asset class of cash, the money at the bank. And so, again, it's a little easier to look on it. We edited this printout a little bit to make it cleaner on the slide that you're seeing. But each one of those brown bars is a year. So we're going back 30 years here to go back to 1994. And what you see in those brown bars is that's how much income would be generated in a savings account or a CD. Yeah, you remember those days back in the 90s. The blue bar, the little dashed blue bar, is the rate of inflation. And so what you see has happened in the last 10 years. The rate of inflation far exceeds the amount of return that's possible to get out of the market right now. So when you're looking at 2021, you would have earned in your typical CD or bank account around $70. What you needed to beat the rate of inflation is $4,900. So you're underwater. And so when many conservative groups are thinking that, well, we need to keep it in the bank because this is God's money and we can't put it at risk. Putting it in the bank is far riskier in this economy than mutual funds or investment accounts. So we're only on about the fourth or fifth slide. These are not a problem.
It looks like you got a
We're glad you're here.
good enough crowd here to have a good discussion.
Well, it's kind of representative of our society. It's always fun to talk about other things other than money.
Even though everyone needs help with it, right?
Yes, yeah, we're all going to have needs in the future to help. So this slide is just talking about how you can't earn any money on cash right now. This slide, again, is not representative of our funds. It's by J.P. Morgan, one of our fund managers. And this is a little complicated, but when you got a chance to spend a minute on it, I think it gets pretty easy. If you look at the second one on the bottom here, it says rolling 5-year average. So down here it says 5-year. So we're looking at a range of stocks, bonds, and blended returns from 1950 to 1921. So 70 years of investment history here. And so what this means is any 5-year rolling period of time from 1950, your average return of a 50-50 portfolio of stocks and bonds was 9%. The best 5-year period for a 50-50 portfolio did 21%. The worst 5-year period did 1%. So you can see stocks did better, but also could have a rougher patch. There was one 5-year period where there was a negative 3-year return. Bonds, government bonds, remember bonds are going to lose interest when there's inflationary periods and things going on. So bonds have made as much as 23% in a 5-year rolling period, but lost as much as 2%. But if you put the two together, you've got that asset mix. And so the same thing with 10-year is that if you look at the 50-50 portfolio, the average high mark was 16%. The average low mark was only 2% positive. And in a 10 or 20-year rolling period, a 50-50 portfolio made 14% is the high year mark, and 55%, positive 5% return in a 20-year period. So when we're talking about individuals, again, disabilities, deaths, divorces, marriages, raising children, these graphs are a little bit more difficult than they are with ministries. Ministries, even in Colorado, with some pretty young churches, probably decades old. Yeah, 30.
34 years, I think.
How old is your congregation?
My own congregation is about 105.
Yeah. So you've got a lot of rolling 1-year, 5-year, or 10-year, or 20-year periods of time. Got some time to do some work. And that's some of the advantage our seminaries have and the universities, is when they started these endowments decades ago, they've educated people on estate planning gifts, and they've had time. So again, this long period of time from 1950 to 21. So Trinity, where I belong, in Soulard in St. Louis, 183 years old, 9 generations gone through there. Lots of time to do this. Unfortunately, the leaders of Trinity in the past did not do any long-term investing, and we're playing catch-up for the last decade.
Just curious, what was the best 5-year period about, roughly? Which 5-year period showed that large percentage?
So the best 5-year period of a 50-50 portfolio would have been 21%.
No, I mean, which years?
Which years?
Which 5-year period?
I don't know exactly. My opinion would be that would be the late 90s, probably the late 90s.
I was just going to assume that. But
Leading up to the tech bubble,
thinking about how all that
the
worked.
birth of the internet and all that.
I was just curious.
Yeah, it'd be my guess. It'd be the late 90s. Probably the last 5-year rolling period, we might see a number close to that too. But that would probably be an old number. So we're dedicated for help for LCMS ministries. There's a lot of organizations that kind of smell like us with their word Lutheran in it. There's Lutheran Legacy Fund. There's Lutheran Legacy Deo. There's Lutheran Foundation of St. Louis. There's Lutheran Foundation of Indiana. We are the organization that was created by Synod for LCMS entities. So there's no copyright on the word Lutheran. Organizations can use it. And so even Thrive in Financial used to use the word for Lutherans, not really affiliated with the church. So we understand ministry. And I often use the analogy that if a congregation is investing with the LCMS Foundation, there's going to be a period of time where everybody on that endowment committee is in heaven. And me too. But the nice thing is that you've got a ministry working with a synod ministry. And so when the endowment committee in 2100 says to us, what did they do in 2022? We might have some records that you've given us and we've microfished it and can answer those questions as we do right now for 30-year-old investments, 40-year-old, 50-year-old investments. I apologize, I can't get this clicker right. You have to go down to go forward. My brain doesn't work that way. So again, we're part of Synod. In 1958 Synod Convention, the LCMS Foundation was created. And so that's what that slide is on the bottom of slide number 9, is that President Benken was one of our longest serving synodical presidents, I think for about 20 years. And so the foundation was created on his watch to be created for the service of the entities of the Synod, meaning schools, churches, the seminaries, the universities. And so again, speaking to who we are is just like Concordia Plan Services is the benefits department for myself and you if you're more than part-time. And there's Concordia Publishing House that we can get our Bibles and hymnals and VBS materials for. We were created by Synod. We are the organization to help with long-term investing. So one of the questions I get asked a lot is, well, how are you different from the Lutheran Church Extension Fund? Aren't you in competition? No. The Lutheran Church Extension Fund only works with the asset class of cash. Remember the bar graph? They only work with cash. So they pay interest on deposits, and they lend that money out for churches to build and schools to build and mortgages for pastors and rostered church workers. But they do not invest in the stock and bonds market. We do not intentionally invest in cash. We do it as a convenience for transactions, but we focus on the longer term asset classes. So one of the things is a little confusing, but I'm not going to be around long enough to change it, is LCMS, LCEF uses the word investor. Wall Street would not say you're an investor if you're putting money in the bank. So it's a little confusing. It's entitled to be confusing, but Wall Street would not say investing is putting money in the bank. We're talking about longer term assets than cash when you're talking about investing. And so our focus is...
Do you do private as well as church? I mean, do you do it for like congregation members, or is it more just church?
We don't do investing for congregation members. We're actually organized as a non-profit organization. So we're a ministry to serve ministries. And in the United States, to go outside those boundaries, you need to be covered by the Securities Exchange Commission, and there's a whole layer of regulations and stuff. Now, where we do work with individuals is in the form of gift planning. So we have a team of gift plans. So in Rocky Mountain, we have, maybe you've met or heard of Jason. It'll come to me in a minute. It is headquartered basically in Metro Denver. And so we have a team of 20 gift planners around the country that sit down at the kitchen table at no cost with the Smiths and the Helfriches and the Joneses and help them plan a gift for maybe today, but usually a gift at death to ministries. And so we have 20 around the country. There is, like I said, a full-time one in the Rocky Mountain District. So those are the two things we do. So the gift planners work with individuals. They get into complicated situations, and we have a staff of 3 full-time attorneys that support their work for gifts of real estate, farms, businesses, houses, where you can take that house and generate income for life. And if you've been around the seminaries or the universities, you hear about a permanently endowed chair, for the science department or something. There's a good chance that a donor had that on their heart to support the science department, and on death gave that money to us to pay to the university to endow a chair, permanently endow a chair. And so that's how we help with individuals. But
Can I just ask clarification on that?
Mm-hmm.
I never thought of asking it this way before, so I guess this is a good time. So for the gift planning, which I'm very familiar with for individuals, all of the situations I'm familiar with where your gift planners are working are talking with people about their planned gifts going toward a church agency of some type. Is that the requirement, or is that?
That's a great question.
Works?
So-
Are you allowed to work in gift planning for an LCMS member in a congregation where their gifts have nothing to do with the agencies with whom you work?
When our gift planners are working with an LCMS member, the expectations are that the gifts at death will be at least 51% to LCMS entities.
Is that expressed to the person?
Oh, clearly.
Is it working with them?
Clearly.
I never thought of asking that. That's how I always assumed it was.
For instance,
Like it would be outside of your charter or your permission.
yeah,
Somebody,
it is.
because they're an LCMS member who wants to give to
We've turned down some pretty big things because they weren't going to go to LCMS entities, go to a public university or something like that. So my personal gift plan is, I'll share with you, I'm single. I was in financial services for 30 years. So I've been an investor over time. I'm not wealthy, but I have a decent retirement account for being a church worker. So upon my death with no spouse or children, why pass along that wealth to nieces and nephews or great nieces and nephews at a taxable situation when they might be in their highest paid professional lives? My nephew's a doctor, my niece is a principal, and the other one is in development for a university. They're making good money. So what my gift plan is that upon my death, working with the gift planner in St. Louis, is all my taxable retirement account goes to what's called a charitable remainder unit trust at the Lcms Foundation. And for 15 years, they're going to pay income to 4 great nieces and nephews and my church. So 5 entities are going to collect income for 15 years over whatever the value is of all my retirement accounts. After 15 years, then that account is liquidated and goes to 8 charities. 2 of them are St. Louis cultural institutions. We have Forest Park Forever is the oldest, largest city park in the country. I don't know about oldest, but definitely largest. It's much larger than Central Park. And there's also the St. Louis Municipal Opera, which I've had season tickets to for about 15 years. Muni, yeah. So a small portion of my gift, but probably 75 to 80% is all going to LCMS entities like my church or the Lutheran High School Association.
And those two places couldn't exceed 49%.
Correct.
For you to be working to.
Yeah.
Thank you. Now that clarifies something I always.
Because the LCMS attorneys wrote that document. I can change it. In fact, I did. Recently, I took a Lutheran organization out of it because I wasn't happy with how they were handling it. And I have a gift to the seminary in that. And originally, I had restricted it for student aid. I'm pretty comfortable with the leadership at our seminaries. And so I removed that restriction, and I'm just giving that money to the seminary. You decide where it's needed. So how I change that is I tell the legal staff, or I tell the gift planner, he tells the legal staff, they prepare a 1-page document, and my signature is notarized. It's that simple. It's not like writing a codicil to a will or a trust or something like that. So it's very, very helpful. Good question. I appreciate asking that. So our investment services, we're working with, just got the number for December 31st, 525 different congregations and ministries that we're working with. And then we have over 5,000 of those donor trusts, like I just said mine was going to be. We have 5,000 of those that we're managing from generally, almost always, people that are now in heaven. And of those 5,000, our team of 8 prepares a tax return that's due March 15th. So they're kind of crabby right now. And there's 3 printers outside my cubicle. They've gone, the last week when I was in the office 2 days, they emptied a case of paper in one day because they need, the United States government, that type of tax return has to be filed on paper. Crazy stuff. But we're able to focus on the long term. And because we're large enough, and I'll talk more about that, our fees are very, very low. So when your fees are low, particularly in comparison to mutual funds, there's more money left in there for ministry because we're not doing this for Wall Street profits. We're doing this to help ministry. And here's an example of some of the returns. Is in the very fine print down here, based on 705 higher educational endowments measured by the National Association of College and University Business Officers, known as NACUBO, from 2000, the year 2000. Is our aggressive balance fund, remember when you're talking about asset allocation, it's a balanced fund, 75-25, we'll talk more about it. Our 5-year return and our 10-year return has beat the average return on 705 universities throughout the country. So 705 NACUBO, again, that means National Association of College and University Business Officers. So our 10-year return is 8.5%. The average was 7.5%. The 5-year return is 5.7%. The average was 5.2. That's pretty remarkable. Our board has gotten those statistics from our investment advisor for several years, and then a new person on the board says, "Are you telling people that?" That's pretty remarkable. So you're one of the first people that are seeing this slide. This is our actual performance on our aggressive balance fund and our moderate balance fund over the last 15 years. So you remember that financial crisis? There it is right there. If a congregation had invested $10,000 in 2006, ups and downs, whoop, don't do anything. Just stand by. And so a $10,000 investment 15 years ago in our aggressive balance fund would be about $29,000. This is assuming no additions, no withdrawals. Fees as they are in reality. The moderate balance fund, which is 50-50 stocks and bonds, we'll talk about more. A $10,000 investment would be about $26,000, $27,000. If money had been left at the bank, the 90-day T-bill, treasury bill, is generally what the CD and the savings account markets follow. So it's a smooth line, but $10,000 invested in 2006 is now worth $11,500. Woo! So that's the value of long-term investing, and that's the biggest. I'm retirement age, but I'm motivated that I've got to get some of this money working for the Lord. We are guided by an investment advisor called NEPC. They would have formerly been known, our parents would know them by the name of New England Pension Consultants. We are on the second floor of the International Center. On the first floor, and some of the second floor, is Concordia Plan Services. Concordia Plan Services, between mostly the pension plan, but also reserves for health insurance and disability, they're managing $7 billion. We're managing $1.2 billion. So at one organization, or excuse me, one address in St. Louis, two organizations are managing over $8 billion. NEPC only has 300 clients, and they're giving advice on $1 trillion in assets. So what it means is there's no universities or seminaries that are big enough to be working with an organization like NEPC. So when I talk about our 50-50 balance fund, our 75-25 fund, those are guided by NEPC. And you and I don't know anybody who can work with an organization with that kind of power. But collectively, we do. And so I mentioned Concordia Plan Services also uses NEPC, and we're pretty comfortable with our pension and where it's at. We have 14 fund managers, we'll talk about in a minute. Of those 14 fund managers, 10 of those are shared with Concordia Plan Services. So like those handouts I handed you earlier with JP Morgan, Plans uses JP Morgan, we use JP Morgan. Our fees from JP Morgan are linked together with their $7 billion and our $1.2 billion. So if you're going to the Edward Jones office or the Thrivent office, you don't have that kind of buying power to get discounts. As far as investment oversight, our key partners are our member organizations. That is Synod, CPS, the universities, the district presidents, all oversee our operations on an annual report. We have a board of trustees. Some are appointed by Synod, some are appointed by our board. NEPC, I mentioned, our investment advisor, and we have 14 fund managers. Investment custodian is U.S. Bank, and we have 2 audits done annually. So one is a traditional financial audit, and the second is what's called a SOC 1, SOC-1 audit. So you're an accountant.
I'm a pension consultant.
Oh,
By day.
okay.
My day job.
Oh, sweet. Blessing to the church to have you. So we have a SOC 1 audit performed every year. What a SOC 1 audit does, it audits your procedures. 5 years ago, the concern in one of our first SOC 1 audits is that are we going to be able to operate, since we're in a denominational headquarters, what if there's a terrorism attack and you can't go to work? And so we were set up that we could operate if the Lcms building was uninhabitable. Well, it happened, but it was a pandemic. And we always had a skeleton crew there because we are mailing out checks and we are receiving deposits. So we never had nobody there, but we went from about 35 in the office to down to some days 3 to 6. And then when I mentioned we're a team of about 54, there's the 20 deployed gift planners around the country. So daily responsibilities, our fund managers, investment advisor, work with our staff, and we're sending money back and forth to our custodial bank. Monthly, there's a staff investment committee. We review performance of every manager on a monthly basis. We don't report that to ministries because monthly is not long-term evaluations, but that's what we do. We micromanage it. If I'm in town, and last week I was in southern Missouri, next week I'm going to be in western Missouri, and a week after that I'm going to be in New Jersey. But if I'm in town, I sit in on the staff investment committee, and what's going on right now in this discussion is that we're going to replace one of our small cap managers. They've been underperforming for nearly 3 years, and we're in a market cycle, but we have other managers out there that are doing a better job. So our staff and investment committee has made a recommendation to the board investment committee yesterday or today after working with NEPC, who the replacement will be for Wellington. If you know anybody working for Wellington, they're out the door in a very short order. Annually, fund managers are required to be face-to-face now. That was waived a little bit with the pandemic. But these fund managers then, it's our staff investment committee and Concordia Plan's investment committee if it's also a manager that they work with. So the Concordia Plans people have a different perspective than our staff, and so it's nice to have them interact with different questions to these fund managers. So I'm going to give you our investment policy. That's reviewed on an annual basis and it is under review. And then I mentioned that we do an audit and a SOC 1 audit. Those are available on our website, or I can mail them to you in a hard copy. So our investment philosophy is to be sure we're well diversified. We're long-term investors, or we're fully invested. Our portfolios do not intend to ever have cash in them. Now, when we're making this transaction out of Wellington and our domestic equity fund, we might have, 5% in cash at the end of the month because of this transaction. But we don't normally have money invested in cash. And we work with the traditional assets of, as I mentioned, pretty vanilla funds. We use a mix of both active managers and passive managers. So you hear a lot of talk about index investing, which is synonymous term with passive investing. Index investing, passive investing is computerized trading. There's no salaries and benefits making the decisions. Active management is where there is salaries and benefits making decisions. So an example of where we use a passive manager is BlackRock has about 60% of our large company investments. We had active management for many, many years. BlackRock was consistently beating them because of those salaries and benefits that are in large cap managers. But where we do use active management is like in the small caps. Small companies need to be evaluated and visited, so we have active managers where it's appropriate. These are the actual managers we're working right now. Most of them are not household names, but you'll recognize the rock here. That's the PGIM is the institutional side of Prudential. JP Morgan, that's who did the handouts I gave you earlier. Center Square is the only manager we have that would be called a sector fund. It focuses on real estate investment trusts. Remember our first slide that had all the different things? Real estate investment trusts have been the best performing asset class about 12 of the last 20 years. We only have 5% of one of our funds that has the Center Square in it, but it's to help pick up, again, active management, help pick up the slack. BlackRock is, of course, the passive management. Global Alpha is a new kid on the block. They are a international small company fund, and they replaced a manager in the last 12 months. He's already got Wellington off of here. Yeah. Oh, there it is. Yeah. So Wellington's getting terminated. And so when we have probably between $20 and $30 million in small companies in Wellington, we'll be moving that over 4 months. We're not going to move it from one manager and get caught in a market correction when all that happens. So we're going to do it a little bit gradually, but it'll happen by the third quarter of the year. These are the asset classes that we work with. So now I'm going to give you more information than you want. If you want more of any of these handouts, let me know. I'll also be willing to do a Teams presentation or a Zoom presentation with some of your leadership. So if you'll open up the folder, the two things on the left, they're about the same thing. This is the technical nature of the investment policy, the do's and the don'ts. Marketing people made it pretty. Okay? So this is what you read on the airplane on the way home. It'll put you to sleep, and then you can throw it away when you wake up, and this is the pretty. One thing I do want you to see in here again in the technical nature, and you don't need to get to it if you don't want to, but I'll read it to you, is on page 17, where it's talking about the investment guidelines for our separately managed accounts, is we're part of Synod. So on page 17, these investment guidelines are giving to the managers, item G on the top of page 17, Direct investment is prohibited in securities of companies whose activities include direct participation in abortion or that foster racial discrimination. Staff will provide a list of prohibited companies. So the racial discrimination thing is an old Lcms hang-up on back to the apartheid days, before either one of you were working probably. But racial discrimination could happen in international companies. And so our international managers are challenged to be sure that if we're buying companies in Brazil or Portugal, that they are not practicing any racial discrimination. And of course, the terminology there about direct participation in abortion is the morning after pill. So this folder, combined with the slides you're working on, I'm sorry to give you a lapful. So the preference funds we have on the slide are covered on page 7 in here. Again, this is the pretty. So we've got these managers, a bunch of managers that make up our core bonds, which is bonds from U.S. governments, agencies, and mortgage-backed securities of high quality. Then we have U.S. equity, publicly traded stocks in the United States. They could be large, they could be small. They might pay dividends, they might not. International equity is publicly traded stock in not in the United States. So sometimes you'll hear the terminology of a global fund. A global fund means around the whole world. The United States is the biggest economic power of the world. So 60% of a global fund might be USA. But when you hear the term international, it means around the globe, not in the United States. So it's quite different. And then we also offer a high yield bond fund. This scares conservative Lutherans. High yield bond funds is companies you're a customer of, like Sprint, Ford, General Motors, Bed Bath & Beyond, AutoZone. They all have a ding to their credit rating and borrow money at a higher rate of return. So ministries could invest with us in these asset classes that we call the preference fund on page 7. And that's what they would have done 25 or 30 years ago. In a smoke-filled conference room at church, they would have said, well, I don't want any international fund, or I don't want any high yield, so we're going to do this, this, and this. But with, again, guidance from NEPC, we take these 4 asset classes and we build what we call the standard funds. Wall Street would call asset allocations, and they're broke down on page 8. So those 4 asset classes, you can see them in the middle of the page is the moderate balance fund. It's 50-50 stocks and bonds. And you can see how much of the different funds or managers, preference funds, which are made up of the different managers. The aggressive balance fund, again, is 75% equity and 25% income. Most congregations find for their typical endowment fund or scholarship fund, those are most appropriate. Some choose to be more conservative, which means you're in more bonds. In a rising interest rate environment, that's a little bit like playing with lighter fluid. So not a good idea to be too much in bonds in a rising interest rate environment. The other thing that's in your folder, it's probably the second thing on the right side, is the performance report of the standard funds. It's got a little mustard highlight in it on the word. So this is the performance performance report for December 31st of these standard funds. So you'll see in the middle of my slide here, the moderate balance fund is 50-50. On the middle of this page is the standard moderate balance fund. You'll see bold numbers and non-bold numbers. The bold numbers are actual return. The non-bold numbers is the benchmark that we're measuring our managers by. So in that middle one, the moderate balance fund 5-year return in bold is 9.1. The market did 8.9. The 10-year return is 8.4. The market did 8.3. The aggressive balance fund in 5-year return is 11.4. The market did 11.4. 10-year return is in bold, 10.2. Market did 10.10. How did you beat the market after you paid the managers? Because that's what the fine print says at the bottom. We paid the managers, and this is the report after we paid the managers. It's our size, and it's a combination of low-cost passive management and high-quality active management. None of these managers have guaranteed employment, and they're all reviewed on a regular basis. Any questions on that? Sorry to make it a little uncoordinated with all the different handouts, but to me it's the best way to describe it all. So the fees that we pay those managers is in your packet. The average fee that we pay these managers is 0.3, 1/3%. You don't see that because, again, that's after performance. The fee that you do see is on slide 22, 0.55, 0.5% is what it costs us to run the organization. So if you're getting quarterly statements from us, you will see 1/4 of 0.55 deducted every 3 months. So 0.55 is an annual amount. And for accounts that are over $1 million, and that can be multiple accounts at the same ministry. You could have a scholarship fund for the school, a scholarship fund for the church, an endowment fund, and a rainy day fund. And then that's where I think a lot of ministries are falling down. Is like personal planning. If you've got more than 3 or 4 months of your budget sitting in cash, emergency money, consider investing for the long term. So there's more resources for the next generation. We have no load fees, front-end charges, or redemption fees. Now, one thing that makes us smell very different than mutual funds is mutual funds or our retirement accounts, they do daily pricing. So you can see at the close of business, about 2 hours of the day, the average price of those mutual funds and things. We only work with Lcms ministries, so we don't own the software or employ the people to do all those daily calculations. We only buy and sell at the end of the month. And so it really lowers the cost. But what it means for ministries is if you call our office on February 18th and you say, we want to take out $50,000, we'll remind you that it's going to happen at the end of the month. And we'll be either wire transferring that or mailing it. The other blessing for how this all works together that I had to get my head around after selling mutual funds for 20 years is that if you ask for $50,000 for the end of February, we don't have to sell securities to give you that money because we got money coming in from Holy Cross and from Concordia Seminary and from Trinity. And so we settled your $50,000 worth redemption through, through cash flow instead of by selling securities, which lowers transaction costs. When you're not buying and selling, you're not creating those transaction costs. Excuse me. I bet that sounded good on the microphone. So how we're different than the Wells Fargos and the Edward Joneses and the Thrivents is we only work with Lcms ministries. We don't work with individuals. The efficiencies, or Wall Street would call breakpoints, in expenses are realized by all of our ministries linked together. So Concordia Seminary has about $135 million with us. Your congregation, with $5,000 as a minimum to open an account, is buying with that kind of a discount on management expenses. We don't trade daily. All securities purchases and redemptions are on the last day of the month. We are not securities regulated, so we don't give investment advice. I did that. I had 4 securities licenses. Since I'm not in the business, I can't practice them. So we can provide guidance and answer questions, but we're not going to tell you what's right for your ministry. Long-term investment horizons with expectations that our fund managers meet or beat the benchmarks they are evaluated by. And that's what's happened to Wellington. Long-term expectations for them to meet or beat the market. They don't have to beat it, they at least meet it, and they haven't done anything. Well, they haven't been terrible, but they are underperforming other managers that are available. So we'll be working with a different manager. Detailed statement of policy and objectives. That's right here. It's written in conjunction with guidance from NAPC. Our standard funds that we were talking about, that 50-50 moderate balance or 75-25 and aggressive balance, Wall Street would call those asset allocation models. And so that's what's neat about the way we built these funds, is most ministries need it simple because they don't have the horsepower, or maybe the next generation won't have the horsepower to make investment decisions. So these are asset allocation models. So if you develop a policy that we're 50-50 or a moderate balance or 75-25, we'll keep you there because we rebalance those funds at the end of each month. We annually report to Synod leadership. There's a fall conference that happens every year. And our Lcms Foundation annual meeting then includes the entire District of Council of Presidents and the leadership of seminaries and Synod, Concordia Plans, CPH. They hear a report from our auditors. And again, 2 audits are done, a SOC 1 and a traditional audit. If you're moving from cash today, as is a lot of ministries are, we suggest to use a technique called dollar cost averaging. Instead of putting the money in all at one time, you put it in gradually over either 6 months or 12 months. So accounts of either new money of $50,000 or additions of $50,000, you can give us the lump sum and ask us to dollar cost invest it over 6 months or 12 months. So we'd put in 1/6, 1/6, 1/6, 1/6, 1/6 till it's fully invested. I'll give you 2 examples. One where it was very successful was in 1999. I worked with a congregation that had sold a large piece of real estate, and they had little over $3 million. And they invested with us in November of 19 and gave us instructions to 6-month dollar cost averaging. Well, what happened in March and April of 20? We had an 18 and 17% correction. So 1/6 of their money went in at the end of March, and 1/6 of their money went in at the end of April. That account now is less than 30 months old and is worth $4.5 million because they bought at such a sale. Now, it won't always work that way. Had you done 6-month dollar cost averaging in 2021, you would have been under the market, because in 2021 the market pretty much did all of this until you hit about December 10th. Then it went down a little bit. But if you were investing in March, April, May, June, July of 2021, you would have been better putting it all in March. But what dollar cost averaging is good for is for treasurers and business managers to sleep good at night. Is that somebody doesn't stand up in the back of the room and say, well, why did I do that? Now, if you're already in cash and you're not happy, if you're already in investments with Wells Fargo or Edward Jones and you're not happy with performance, or you know you're paying too much in expenses, then I don't have a problem. It's only when you're going from cash that we really encourage to do dollar cost averaging. And that's the end of the structured talk. A few other things that I'll show you that are in your folder is the quarterly report of the performance, again, as of December 31st. What's neat about it is those preference funds, those different asset classes, it gives you some detail. On page 3 of this, it talks about the domestic equity fund, that's stocks in the United States, and you can see the actual managers, and you can see what their performance was and how much of the portfolio they have. So what you'll see on page 3 in the domestic equity fund is our top 10 holdings: Apple, Microsoft, Amazon, Alphabet, Tesla, Alphabet. There's two different share classes of Google is what Alphabet is. Meta is, of course, that's the new name for Facebook. NVIDIA is in the tech chip market. Berkshire Hathaway, United Health Group. And here's what's really cool is on the left side of page 3, number of holdings in the portfolio, 1,241 different securities. Your average mutual fund has about 100 or 200 different securities in it. We're diversified across all these different types of domestic markets and over 1,200. So if you're choosing the moderate balance fund or the aggressive balance fund, you're spread out over 5,000 securities. You're part of the owners of 5,000 different securities. The other thing that's in the folder for technical information is expenses. So the bottom 1/3 of the page shows that 0.55 that I had on the slide is our annual operating expenses. The top 2/3 of the page is what we're paying those managers. So if you're in the moderate balance fund, on the left side of the page, you'll see that the internal operating expenses is 0.27. You don't see that because that's after our performance. But a fair question is, well, what's your internal operating expenses? It's 0.27. The other thing I put in here is there's a website, a guy called, what's it called? thebalance.com. He talks about the annual operating expenses of mutual funds. So a large cap fund, the average expense is 0.86. A mid cap is 1.0. Small cap stock is 1.1. You compare that to our moderate balance fund, 0.27. Because these expenses are all of our funds, the seminary's funds, and the pension plan health insurance reserves. And then there's a flyer in here about dollar cost averaging. So to some people this is a new concept, but what is dollar cost averaging? Why would you want to consider it? Again, it doesn't always work to your advantage. It's basically no-dos for treasurers, so you don't get upset at night. Covered a lot of ground. Hope it was helpful. It's with your pension background. Did I connect it all?
Yeah.
Any questions?
That's the colorful chart on a regular basis.
Yeah. Mm-hmm. Yeah, as a pension consultant. For who?
Epic Retirement Plan Services, we've got offices in St. Louis and Peoria that were previously independent acquired. But our corporate headquarters, because we got acquired, is in Rochester, New York, and we're owned by a bank.
Okay. So a little bit of my background is that after, I'm going to turn